The Kelly Criterion, we decided we were going to talk about this a little bit, and we're going to be joined, as always on Fridays, by my good friend and colleague, Professor Mark Guttner of Rutgers, and he's going to talk to us a little bit about Japanese bond yields and what that could be signaling today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guttner. Mark, how are you? I see you're back in your office. You're not working from home today.
Not working from home today. Got lots of stuff to work on, some research to do. So the nice part is in the summer, there's not too many people around, so there are very few distractions. I can put your head down and go.
Well, summer is about to begin for everybody. I guess it begins a little earlier on college campuses, but we've got Memorial Day coming up, so soon it's going to be summer for everybody. I mentioned on Wednesday that I wanted to talk a little bit about the Kelly Criterion, and we're not going to get into it in too much depth. I think we have a couple of slides. I just wanted to go over this to provide a little bit of an outline. So that is the Japanese bond yield. So yeah, the whole idea behind the Kelly Criterion, and yeah, we could actually just advance this to the first slide probably. The objective here was that, and I actually learned a little bit more. I had mentioned on Wednesday that John L. Kelly Jr., as I now know, was a scientist at Bell Labs. So he was a University of Texas at Austin trained physicist. He had a PhD. And apparently what he was working on was trying to optimize traffic over, as you would expect, telecommunications lines. And it turned out that some of that work had other utility. And unfortunately, I hear the gardeners blowing machines coming close to me again. I thought they were done. I was hoping they were. One of the things that he figured out was that if you were trying to maximize the geometric return in a gaming exercise, that there was some utility. So why don't we just advance a couple slides here? Let's yeah. So I mean, here, yeah, we can just go one more slide. There we go. So that's actually a picture of him. I was saddened to learn that he actually didn't live very long. He only lived to be into his 40s. He had a stroke in Manhattan when he was, I don't know, I think it was 43 or something. The formula there is the one that applies to a gaming exercise. Now, the important thing that I want to make a distinction about with respect to a gaming exercise versus trading options is that, and I was just talking to Mark about this before we went live here, that in a game like whether it's poker or blackjack or roulette, the odds are known, as is how much you're risking, as is the potential payout. Now, in something like roulette, it's very straightforward because depending on whether it's American or European roulette, you have something there. With respect to poker, it's a little bit more nuanced. For example, if you are playing Hold'em and everybody has their two cards, but you haven't, none of the center cards have been shown yet, you have some sense of what your odds are based on the cards that you're dealt, based on how many other players are there. And the thing that is not entirely clear at the outset is what the payoff will be, because that's going to depend on other people's betting behavior as well. But the simple thing is that F in this formula, which is what you're trying to establish, is the percentage of the capital that you have, the amount that you have, that you should be betting. And the rest of this has to do with the probability of a win or a loss. So using that as a framework, and we can probably advance here to another slide. So yeah, it was Don Rumsfeld, I think, who was the one that coined the known knowns, the known unknowns, and the unknown unknowns. Well, in the options world, we're going to be dealing with several unknowns, I should say, which is that we don't know exactly what the payoff will be. We have to estimate that. We don't know what the probabilities will be. We have to estimate that. we also don't know how much, if you're short options, the amount that you could lose is also unknown. So there's a lot of unknowns that you have to estimate. So what does this do when it comes to using something like the Kelly criterion? Well, you have to modify it a little bit. So we can advance here to the next slide. So one simple way to think about this is that you need to handicap your own bet. So the example that was provided on Wednesday, we had a viewer who was saying that their bet, I think, was that Bitcoin was going to go to 150,000 by year end. And so we were looking at a trade in IBIT. And there's a couple sets of probabilities that you want to apply in a situation like this. The first is we should assume that the options market does have some information. This comes from that whole concept of the wisdom of crowds. It comes from the concept of an efficient market hypothesis. So you can use an options delta to get the market's estimate of the probability that the stock reaches or exceeds a certain level, either up or down. And then when you are making a bet using options, what that means is there's a good chance your view on the future differs from the market's view. Because if it was perfectly efficient, then presumably the options were fairly priced. So if you're going to have a view that differs from the market, unless you're privileged to have inside information, and there are people that have inside information from time to time, and unfortunately they trade on it too, you have to handicap that. So that will mean that you need to reduce the size of your bet. So for example, if you're willing to assign a 25% weighting perhaps to your own forecasts and a 75% weighting to the market's forecast, that doesn't mean you don't have edge. It just means that you don't have maybe the same probabilities that your wager would otherwise suggest. And so you would downsize your bet. So an example that I provided here is that you might just take your own weighting, and bear in mind that these are going to be distributions. You probably have a target, and then you have some confidence around that target, as the market does as well. But that's a way to think about the Kelly criterion and apply it to your own betting and wagering. Okay, so with that, I thought we would move on to what Mark had to say, because this is really interesting. We've been focusing a lot on U.S. Treasury bond yields lately, which have been kind of scaring the market a bit, the 30-year exceeding 5% and all of that. But that's not the only yields that have been rising. So perhaps, Mark, you could guide us through what you've been looking at.
Yeah, so I started to look at this, and I wrote a piece on the Options Edge yesterday about this issue of the Japanese yen carry trade. So it's been very popular trade with hedge funds going on, I want to say, a couple of decades now, where people borrow in yen, which had very depressed interest rates. Oftentimes, long-term rates were really close to zero. Whereas we had treasury bill rates down at zero, they had 10 and 20 or 30-year bonds down in that zero range. But in any event, people would borrow in dollars and then go buy US dollar assets with them. With rates depressed, there was a drag on the currency too. So you'd borrow cheaply. There was some weakness in the currency, and you go buy something yielding 6, 7, 8% here in the States, and you have yourself a nice profit, which that was a trade that worked for a long time. And now I'm starting to worry that that trade has come to an end, and we haven't seen any disruptions in the market yet. But I think that might be the unknown in this market, because it's something that nobody's talking about, nobody's looking at. Japanese interest rates are starting to rise because finally, after printing egads of money, they're starting to get some price inflation. And I have a feeling that price inflation may get out of hand. And so I think we had a few charts. One chart here that's up now. This is the yield to maturity on a 40-year government bond. As you can see, it got down to a hair's breadth above zero. I guess what is that, 2015, and then again in 2019. And ever since it's risen, so now it's up over 3.5%. And for those that own that bond, these are going to be households and pension funds in Japan. They've seen a loss of 65% or more, depending upon if they got top tick or not. I think if they bought it at yield to maturity of 50 basis points and now sitting at 3.5, that they've lost about 65 cents on the dollar. It makes perfect sense. Why? Because they're losing out on 3.5%, 3% at least per year now for the next 40 years. That's a pretty devastating loss. And I think I had some other charts to show that they have some systemic problems that they're going to have to start looking at. Here's government indebtedness of Japan relative to the U.S. and Italy, UK, France, and you can see that they are down below. This is Japanese government indebtedness relative to GDP, and it's pretty doggone high. I mean, it's one would have think that the wheels will have fallen off by now. I think it's kind of remarkable, perhaps that it has. And where we are in the U.S., we're a little over 100%, and we're starting to have a lot of debate about budget and borrowing and things like that. And Japan just powered through. They just kept going and going and going. So I think they are not going to have. They don't have any levers to pull to try to keep their interest rates under control.
So, yeah, I mean, this is kind of an interesting situation. For one thing, I mean, how much of the outstanding Japanese government debt is held by the central bank?
Let's flip to the next chart if we can. That's what we have here. This is the amount of debt that the central bank is holding relative to GDP. The central bank, Bank of Japan, is holding about 100% of the value of the Japanese economy in government bonds, which is enormous. To give you an idea what that is in the U.S., that's something more like 20 or 25%. I think we own our GDP is about 30 billion, 31, I'm sorry, trillion. And the Fed's holding about 6-7 trillion. So I didn't do the math, but it's something more like 20 to 25%. And we're quite nervous. I'm quite nervous about that. That's a lot of money printing, because of course that's how the Fed buys it. They print some Federal Reserve notes, and then they swap them for government debt, and that's how they pay for it. And then that new currency is now circulating around the economy. I think it's remarkable they haven't had a really blow up in inflation in Japan, but maybe that's finally coming now.
So, I mean, I guess there's been a couple of reasons that things have not been, so extraordinary in terms of inflation there. I mean, their economy was moribund for a prolonged period after the excesses of the 1980s. Mm-hmm. And in fact, if we take a look at yields in Japan over time, what we're seeing is that they kind of followed a pattern that's not entirely dissimilar to our own. It's just that they were in this situation sooner than we were. So there was, I guess one of the things we could say is that we kind of followed their model, yeah, in a way, which is that they had a credit problem from excess borrowing that took place in the 1980s, and they dealt with their debt problem with more debt.
Yeah,
as we have done. Let me ask you, what is the dynamic of, so you have all of this long-term debt, half of it little, just for round number's sake, we'll say that half of, it's slightly less, I think it's in the mid 40s, but half of Japanese debt is on the central bank's balance sheet, the Bank of Japan.
Yeah.
So the longer term debt has now been absolutely crushed by this, by the increase in rates.
Yep.
Let me ask, I mean, what would happen if they did effectively now what had Janet Yellen been borrowing long-term debt instead of short-term?
Yeah.
Let's just say that for the sake of argument, she had borrowed $10 trillion in 30 years, all right, when rates were close to 1% in the 30. Well, by now those things have been cut in half. They could then actually issue short-term paper and retire the long-term paper and effectively cut the balance sheet in half. Could the Bank of Japan do something like that and actually, essentially, they're going to retire it by buying it back in the open market at these discounts? What do you think?
I don't see a reason why they can't. I don't know that are not familiar with their laws in terms of what their central bank can and can't do. But in principle, that's probably something they should do, is go in, buy that debt, retire it, issue short-term debt. And interestingly, short-term debt right now is rising in Japan, but it's not rising. It's not as high as the rate on 30-year bonds. So I think it makes a lot of sense for them to do that. And it is a shame that we didn't do that. I don't understand why anybody wouldn't do that. We had 10-year bonds down less than 50 basis points, and as you mentioned, 30-year bonds at 1%. That low goes back, I think, to the beginning of mankind, and that's how extreme they were. And they should have, if they could have gotten institutional investors to buy 30-year bonds at 1 or 1.5%, and they refinanced everything at long term, we'd be in a heck of a lot better shape than we are today.
Well, the interesting thing is that they could have made themselves right. If the Fed played along, they could have made themselves right.
Mm-hmm.
Even if they had issued at 1.5% in the 30.
Yeah.
And then it got to 5. And then the Fed would actually be not changing the size of its balance sheet. It would actually be shrinking it by doing a swap.
Yep. And the Treasury would make a heck of a lot of money. Now, I don't know what that would do to the private sector, because the private sector, of course, would suffer a capital.
Well,
right?
It depends on where that debt resides. So one of the things that occurs to me is that this kind of machination, and if for anybody who's watching, if you're not really following what it is that Mark and I are talking about, when rates were exceptionally low, as they have been in Japan for a prolonged period of time, and as they were here in the United States, basically from the GFC on, but in particular since the onset of the pandemic, because they just decided to double down on very easy monetary policy. That if you had Treasury and Federal Reserve coordination, and they had issued, Janet Yellen, as I've been critical many, many times of the fact that they issued short-term debt.
Mm-hmm.
But a lot of the debt was ultimately ended up on the Fed's balance sheet in any case.
Yeah.
Effectively, what would have happened was that the Fed could have acquired all of that. They basically could have created a bid at the long end of the curve. We could have issued out there, and then we could have issued short-term debt to retire by repurchasing. Now, as Mark points out, I don't know what the legality of all of this is, but I'm just looking at it from a trader's perspective, that would have worked out very nicely. Now, the other point is, who held the debt, right? So if banks were buying, Bank of America, for example, had a lot of duration. JP Morgan had much less. So if you're asking who loses, well, in this instance, it's going to be the Bank of Americas of the world that are losing, and it's their held to maturity book. So you don't see that on the balance sheet unless you look, because these securities, which have been sawed in half, are still being held as if they're, at par, basically.
Yeah.
That's the way they account for it. So in Japan, one would have to imagine that, someone's going to pay the price when all of this happens. And I assume that the price would have been paid by the financial sector, which probably also holds a disproportionate amount of the outstanding Japanese government debt.
Yeah.
But it rarely feels to me like policymakers are doing anything but enriching the financial sector. They're rarely taking much from it. So,
Well, I don't consider the federal government to be the smart money.
No, I suppose not. I suppose not. So let's talk about what unwinding. And there was a lot of talk about this about a year ago, I think, because basically what happened was we saw a sort of a spike in the Japanese long rates. Then they came in a little bit, so people kind of quieted down, and then more recently, the increase has been much more steep.
Yeah.
And I think I have. Let me see if I can. I should see if I can pull up. I want to pull up.
See if you can get their yield curve.
Yeah, let's see.
And maybe a couple of dates. See, it's the rising of the rates that may have a spillover effect in the U.S. because if rising rates starts to bring some strength into their currency, and those rising rates make the cost of financing U.S. dollar assets higher. There's going to be
I have the yield curve up now.
There going to be some pressure to unwind the carry trade, and that means some selling pressure on U.S. government or U.S. government securities, and maybe even equities for those that really went out the.
So, well, the other thing is that even if so just again for people who are wondering about the mechanics of all of this, if I could borrow money abroad at 1% and then invest it someplace else at a much higher rate, that's essentially a positive carry trade, right? That's perfect example. Doesn't really matter what it is. Sometimes people can borrow at very low rates and they invest it into riskier assets. But if the example that Mark's providing is that the U.S. Treasury is not Treasury bonds are not necessarily considered to be a high risk asset. So if you borrow essentially in Japan and then lend here, and you can make 100 basis points, that's very nice business if you can get it. Of course, you are subject to the fact that rates can swing, and that's the dynamic he's talking about. The problem we have is that if rates continue to rise here, even if that borrowed money wasn't being deployed to U.S. equities, it still has an effect, because as the long-term rates rise, what happens to the net present value of future cash flows? They are going to go down. So there is a relationship between risk-free rates and the valuation for risk assets. And so there isn't a free lunch, basically. Let's see here.
Right.
Tucker D. Dog says, federal government might not be the smart money, but the Pelosi's of the world miraculously do well. Yeah. So I think what Mark is referring to is that the policy rarely ends up working out in the taxpayers' benefit, right, but the policy makers sometimes do just fine. So that's
I would say
an important distinction. Actually, that brings up an interesting point. I wonder how that Nance ETF is doing this year. That's the ETF that tracks. Let's see. I wonder if this thing is outperforming U.S. equities year to date. So it's flat year to date. It has traditionally outperformed. Yeah. So there's an ETF that tracks the Democrats and an ETF that tracks. So they are beating the S&P, but only marginally. 86 basis points so far this year. Cruise is the ETF that tracks the Republicans. The Republicans, I've observed this. Their ETF just does a hell of a lot worse than the Democrats. Yeah. And this has been consistently true.
Yeah.
And it's true again this year. Why is that? It's interesting. Very interesting. Okay, so what do you think this suggests people ought to do? I was thinking one of the things that occurred to me, and I wrote about this also on the Options Edge, was that I thought that people who are concerned about further rate increases at the long end could take a look at TLT. TLT is a very low volatility instrument. You could maybe buy some put spreads. The reason I was thinking put spreads rather than just outright puts is because when you're trading puts on fixed income instruments, the carry cost plays into it. So you're going to notice that the downside puts are always going to be, relative to the implied volatility, kind of expensive. And the higher rates go, the more true that dynamic. So I was thinking kind of something like put spreads. Let me see if I can pull that up. What would you recommend?
I like that idea because I think there's one more leg down in 30-year bonds, and then we're going to hit a plateau for a while. I would not be surprised to see 30-year bonds get up around 6 to 6.5%, which would put a lot of stress on the system. That's for sure. But I think that would be it.
Yeah, it's interesting that you mention that because Leon Cooperman was on Bloomberg earlier this week, and he was making similar comments. He was basically suggesting that he thought, rates, the long end rates, could and potentially should go much higher. And one of the things he also pointed out, and I didn't realize this, he went into the business after he got his MBA in 1967.
Mm-hmm.
So he actually got into the business before I was born. I was born a year later.
Wow.
In late '68. And he pointed out that from the moment that he got into the business, for the next 7 or 8 years, equities did very little because they went up. We had the Nifty 50 era, and then we had the bear market of the early 1970s, and he did very well during that period. But he kind of alluded to that as something that people should remind themselves about, which is that you can have situations where rates start to go higher, stock prices were overly exuberant, and you really have to become a stock picker.
Yeah.
And so he really seems to be emphasizing that he thinks that's the environment that we currently live in, which is it's going to be a stock picker's market. You probably need to buy things that are not in the index. He was saying, look, people they blindly buy index.
Yep.
And so that means that the things that are in it just have all of this buying pressure. And he said that you probably are going to find better opportunities looking elsewhere. What are your thoughts on that?
I think that could very well be the case. And in some respects, we have been in a stock picker's market. You only had to pick 7 stocks, right?
Yeah.
So, yeah, you were a winner if you were in the Mag 7. Everything else is sort of languished. There's now a lot of stocks that trade at mid double digit. I mean, like I would say mid-teens PEs, and some names that are close to high single digit. And someday they'll come back into favor, and it's the stock pickers market that occurs when that happens. I kind of like that kind of market better. It rewards research, whereas the Mag 7 kind of thing is everything's kind of known about what they're doing, and you're kind of doing a big momentum play. And that's stocks like Apple, for example, I think, to overvaluation, which has been my argument. I haven't been right in terms of trading, but I think it's an overvalued stock now.
Yeah, interestingly, with something like Apple, of course, I mean, companies like Apple that have massive amounts of free cash flow and buy back their stock, and also are big constituents of an index, they just benefit from money flows, their own and investors. And what I mean by that
Yep.
is that every single time somebody gets a paycheck, some of their money goes into their 401k,
Yep.
some of the 401k goes into the index, and most of the index is going to be the Mag 7 stock. So they're sort of natural beneficiaries. And then they buy back their own stock as a mechanism to return cash to shareholders. And that also creates a measure of support. That also has a tendency to compress volatility. So for those that weight their investments based on risk, the perceived risk is lower. So
Yep.
that also can attract additional assets to people who do risk-weighted approaches.
Right.
So I'm looking right now at a bunch of stocks. So what I did was I just took a look at the Russell, and I filtered this by stocks that have earnings multiples of less than 17. And some of these are, Alphabet, which was a name that I had mentioned I liked at the beginning of the year. Obviously, they've taken it on the chin. And then you and I talked a little bit about the fact that most of their revenues come from search, and that search aspect is not as compelling now that we have all of these large language models, and people are increasingly turning to ChatGPT and to Grok. Hopefully Gemini can pick up some of that flow, but I've become more neutral on it for that reason.
Yeah.
Marathon Petroleum, which is the refining side
Yeah.
of Marathon, I think this is kind of an interesting one. Masco, for those that don't know, Masco is in the building products area, and we've been in a home building recession.
Yeah.
It's hard for me to figure out how that's going to get repaired if rates are high and go higher.
Yeah.
That's a very difficult thing to fix. We've got U.S. median home prices up around 420, 430, something like that. And, the cost, the affordability of home purchases goes down, of course, as rates go up. And that's a difficult one to fix. There is, let's see here. There were some other names I thought that, a name that I had mentioned before on the construction side, more commercial, that I thought could potentially benefit from a build out in nuclear was Fluor.
Fluor, yeah, was my mild employer.
Oh, you worked for Fluor?
Yeah, it was my first job when I got out of engineering school. I worked on building refineries and petrochemical plants.
Ah, okay. Because I knew you had worked in the aerospace defense industry in Southern California on some kind of Star Wars-y type thing. I didn't realize you had also worked at Fluor.
Yeah, I started at Fluor. I had high hopes that I would have a leg up in terms of having a sponsor within the company. My dad used to play dominoes with Bob Fluor all the time, and I thought maybe he would keep an eye on me and maybe help my career a little bit. It didn't turn out that way. And
your dad took too much money off of him or something?
well, the oil industry busted. We went.
Yeah.
And fortunately, Ronald Reagan comes in, wants to start building Star Wars, and so there were lots of engineering opportunities up at McDonnell Douglas, and I really liked working there. At very interesting things that we were designing, building, and testing on a huge campus. And it's interesting when you build processor cards. That would go into missiles and things. Sorry, I got the hiccups, and so if you see me doing something, it's because I'm fighting the hiccups. You can have
a sip of water.
Yeah, that's why I keep having a little sip over here. They would build the printed circuit boards with all the chips on them, put them in a brick of epoxy, so that they could take a big abuse while they were flying through the air.
Mm-hmm. How do you feel about Albertsons? Kroger was a name that I liked a while back, and not because it's an exciting business, it's a grocery store, of course, but these two names have been trading very close to one another for quite some time. They've both been trading around 10, 11 times. And I brought up Kroger, I think, on this channel actually a couple of times, and I often would draw the distinction and say, look, you got Costco at 55, you got Walmart, which is really the world's largest grocery store,
Yep.
does over 50% of its sales from grocery, trading 33 times, and Kroger's trading 10 or 11.
Yeah.
I'm not saying that Kroger should trade 30 times like Walmart. Quite the contrary, actually. But it has really rallied, and I think the last I looked, it was actually trading over 15 times forward. But Albertsons, meanwhile, is, still in that very low double-digit multiple.
Well, it makes sense. They're no growth companies. As a no growth equity, you should probably earn somewhere between 8 and 10% a year over the long haul. So at 10 times earnings, that's about what you're going to get. It's giving you a fair rate of return without a whole lot of volatility.
Well, here's the thing, right? So it's not a growing business, but it might maintain pace with the economy, whatever that is. It might maintain margins and therefore see earnings grow at the rate of inflation.
Yeah.
Right? And it has a 2.7% dividend yield, right? So the way I kind of look at it, you're getting a qualified dividend with an potentially, I'm not going to say a huge inflation hedge, but I wondered whether it's hard for me to imagine. I think it's unlikely it's going to trade down to a 7 handle in terms of its forward turn. So I feel like the downside's a little bit more muted, and you're collecting some income. So I'd kind of rather be in here than in bonds. What do you think?
I like that idea. I'm not a fan of bonds. I don't know if we've talked about this, but if you look at the rate of inflation since 1971, when we completely left the gold standard, the CPI has averaged about 3.5% compounded per year. And it's been my view that the Fed doesn't have a target of 2%. It has a floor of 2%. And we know that, or why do I believe that? It's because every time there's chatter, the rates are coming down, inflation rates coming down from 3 to 2.9 to 2.8. It's moving in that direction. You hear the Fed people starting to talk about, well, maybe we can start to think about a preemptive cut. You see investors who come on various popular financial news shows saying, kind of putting pressure on the Fed too, saying they expect X number of rate cuts in the years ahead. So I don't think inflation ever gets down to 2% ever again for any lasting period of time. Maybe it will for 3 months or something like that. But I see 2% as a floor, and I don't want to be in something that's yielding 4% that I've got to pay income tax on that takes 30% of that. Because at the end of the day, there's no real rate of return. So for a long-term hold, bonds don't make sense. They only make sense if you think that you need a place to park some money while you're trying to figure out what you want to do.
What are your thoughts on the alcohol sector? This has been completely depressed. I know that there's consumer shifts. So, for example, we've seen Brown-Forman has not done particularly well. I've got Constellation Brands up on my screen right now.
Yeah.
This one I think is kind of interesting because this stock right here has essentially been sideways for a decade.
Yeah.
And a lot of that poor price performance actually is stemming from a declining multiple. As you can see here, I'm going to get rid of the price for the stock price for just a second. This is the forward. Is this a forward turn? No, this is the trailing. Sorry, let me put the forward in.
Well, it's okay. They're going to.
They're going to mirror each other, but yeah. I mean, this is the forward turn.
Yeah.
Now I don't know. Perhaps some other people have some thoughts on this, but there are consumer shifts. One of the things that I've heard some people say is that the cannabis industry has taken away some of the alcohol business. Maybe that's true. I don't know. What's interesting to me is that I like to enjoy a glass of wine with dinner. I like to have a beer and a burger on Saturdays sometimes, and that's a very different thing. Like so, I don't smoke, so I can't really speak to that.
Yeah.
I'm not saying there's anything wrong with it for those who do. I'm just simply making the point that it does not strike me that some of the things I'm talking about, social alcohol consumption with dinner, drinking wine with dinner, drinking beer with your burger, uh, that kind of thing is not going to be replaced by cannabis use. People are not going to start vaping at Harris's Steakhouse during dinner.
That's fair to say.
Um,
Yeah.
so I don't know where the floor in this business is, but I am of the view that some of these things are cyclical, and these things have gotten cheaper, and therefore some of the risk has been mitigated. And actually, during some recessionary periods, these are names that have actually tended to hold up all right
Yeah.
historically.
Yeah.
So,
I was going to say what I think as their growth rate, whatever they were doing, I'm sure fundamentally is slowing down. Constellation Brands built their business by having capital and stepping in and buying um, wineries that got into financial trouble simply because of the long lead time. You think about, oh, some guy wants the romance of having a winery. He leaves San Francisco, he buys a piece of land, he plants some grapes, and then he finds out that it takes 10 or 12 years before he has any revenue. And they run out of money. And then Constellation Brand comes in and says, you make a nice wine here. How about you sell it to us? You can continue to live on the vineyard. You can uh, make the wine. You can interact with people at the tasting room, and we'll deal with production, farming, bottling, shipping, storage, marketing, the whole shooting match. And that's how they grew. So they ended up buying wineries on the cheap because they were coming in at the 11th hour when really the vintner was running out of money. It was more of a money problem than a liquidity problem than a value problem.
mhm.
And so they get things on the cheap, and they built a really great business um, that way. There's probably fewer opportunities for that. And they did spend a big
I don't know if
chunk
you
of
just saw
money.
the statistic that our producer just put up on the screen. I thought that was pretty interesting, but it was saying that the percentage of adults under age 35 who say that they ever drink has dropped by 10%.
Well,
Uh, that's pretty remarkable.
yeah. And then I don't know if it's hurt him or not. Maybe it has. It seems to me I read 5 years ago that they had made a large investment in one of the cannabis companies. Maybe it was Canopy. I can
Hmm.
remember a huge with options to buy a lot more, and I think that was a probably a value destroying the investment. I can't I can't remember which one it is that they bought into.
4 billion they put into Canopy.
Yeah, so I would be willing to bet that that investment's worth a very small fraction of that $4 billion.
Well, let's take a quick peek here. So Canopy, they're probably going to be listed here. So the value of that position. Oh my goodness.
Is it worth 100 million?
Oh wow. That's that is a that is a painful hit right there.
Yeah,
Um, it's not even that doesn't even look like it's worth 100 million bucks.
yeah. People were
Um,
crazy about
the whole market capitalization of Canopy is $289 million. They invested 4 billion.
yeah, that they had companies with enterprise values of 40 and $50 billion when they had revenues of like 50 million, um, just like in those dot-com days. And I thought it was, of course, ridiculous, um, because if you went through and did the math, you would something like everybody in the United States would have to have 2 or 3 joints a day um, in order to um, earn a profit to give you
one
a
of the
return on investment, which of course is not going to happen.
Well, the amazing thing in all of this, when people started modeling out these cannabis companies, is that it is absolutely true that the price, the prices for some of these things was very high when it was illegal. And when you make something legal and you get a lot more competition coming in, what happens to prices? Prices drop. At the very least, they level off. And that increase in competition. So
Yeah.
I think a lot of people's modeling, what they did was they said, well, here's the size of the cannabis industry now, and if we legalize it, the size of the cannabis industry is going to be
Enormous. Yeah.
orders of magnitude larger. And they were correct in one sense, which is that in terms of the units, right? So how much cannabis is actually being sold
Yeah.
and consumed. Of course, indeed, that did grow by leaps and bounds. But the amount of profit available was grossly overestimated. That's one part of the issue. The other part of the issue is that in many places, the legalization process, there's a whole documentary about this, that the legalization process, for example, here in California, is quite onerous.
Yeah.
That the fees, the taxes, the filing requirements and things made it very difficult. The documentary covers a bunch of people who were, in the illicit cannabis industry
Yeah.
in the Mendocino area, in what we call the Emerald Triangle in Northern California, that these folks decided to go legit, as it were.
Yeah.
And they've really been struggling to do so profitably. And that there's a lot of folks that have decided, we're not going to go legit because the legit path is not a profitable one,
Yeah.
and the illicit side continues to be. Again, I'm neither a consumer of that product, nor do I produce it, so I don't know that much about it, but I imagine that at least some of what's being... oh, look at this. Cannabis black market thrives despite legalization, and the source for that is none other than Rutgers.
Nice. Yeah. I
So maybe you know, or this would actually be very interesting. Let's find out who put that together, and then maybe you can
find out.
maybe you can get that person to come join us in this live stream. We can talk about this in a little bit greater depth.
Yeah. Yeah. It
That'd be
doesn't
kind of fun.
surprise me because you get rid of a lot of regulation and oversight, paperwork, legal. If you just don't do the paperwork, you just don't do it. And lawyers cost a lot of money.
Yeah.
It was my understanding that when they first started to build these things out and build farms, that the government was actually requiring them to report the number of seeds they buy and who they buy the seeds from, how many seeds they actually put in the ground. And it's just one of those things where
Let's
made it
put
no
I'm
fun
gonna put
anymore.
this. Yeah. Well, yeah. I mean, the profits are really going to be the more important issue, I guess,
Yeah.
for a lot of people. So I'm gonna just put up an example trade for TLT here.
Okay.
If
Yeah, that'd be good to share.
Yeah, so we'll just take a look. Something like this. Buying an at or just out of the money put spread on TLT. And I wanted to show this chart here because I wanted people to have some sense of, get some perspective on how much these rate changes impact the value of long-term bonds, because TLT is the 20-year plus. And so we're going back, this is just a one-year chart that we're looking at here. But you can see that even as recently as the first week of April, TLT was, $93 and change. Actually hit almost $94, and it's $84 and change right now, 7 weeks later. So what this illustrates, and this is what Mark was talking about when he was talking about the Japanese 40-year, right? So we rarely talk about stuff that's that long dated, but you have a whole lot more duration. But when you're dealing with interest rates that started at zero, you also have huge convexity.
Yeah.
which means that a 1% increase in rates for a longer-term bond has a much bigger impact than a shorter-term one, and a 1% change in rates for a bond that is only paying 1%
Yeah.
is going to be much more profound. So if you go from 1 to 2%, that's going to kill the value of a 40-year bond.
Yeah.
If you go from 10 to 11%, that will reduce the value of a 40-year bond, but in percentage terms, that price change is going to be much, much smaller. That's what the convexity, actually, well, I mean, I should be letting Mark say this because, of course, Mark is, you've written books on the subject.
Yeah. So when rates are really low, then the interest rate sensitivity is the highest. And as rates rise and rise, it loses. A typical non-callable bond loses interest rate sensitivity. And that's all that's really going on there. But TLT, those are bonds that have a maturity of 20 years or longer. So we do in the US 20 to 30-year bonds. So if you want to do an average of 25 years, if rates go up by 1%, the duration on that is probably about 23. So you probably lose 23% of the value when the rates were down there at 50 or 100 basis points. So rates go up 2%, you lose about half your money. And that's permanent loss of capital because you've got to wait 20 years to recover your principal with and earn a nominal rate of return. That's pretty harsh. I like TLT as a trading vehicle. That if I think there's going to be a spike or a collapse in interest rates, it's a nice vehicle for you to trade. But it's not one that I would want to buy and hold unless and until rates kind of get up to the 8, 9, 10% range where it's worth it. You're getting enough yield to compensate for the risk that you're taking.
So I actually have a chart up now that actually shows the change in 20-year rates versus TLT over the course of the last 5 years. And it's actually kind of hard to make it out right here. Oops. It's kind of hard to make it out. But what I wanted to point out, if I can get back to it, what did I just do? I just screwed that up. So I'm just going to pull this back up here real quick. So we're going to take a look at a 5-year. So you can see essentially what happened to the value of 20-plus year treasuries. As you said, we'll call it a weighted average of 25 in TLT. Just how profound, and it's amazing because people have often said, "Oh, it's a risk-free asset." Well, not exactly. You would have lost 52% of your capital or thereabouts.
It's credit risk free.
Yes, credit risk free, but credit risk is only a part of the equation. It's funny if you think about it. If you think about a junk bond, right, and you're thinking about your recovery rate, you might use as an assumption, depending on the industry, that your recovery rate will be 40%.
Yeah,
and here you're looking at a rate sensitivity issue that took out 52%. So very, very nearly as much of your principal has been wiped out as a result of the increase in rates. And by the way, the 30-year rate is still only about on or about 5%, just over, right? It's not like we're getting back to to 1980.
Yeah.
So people should be aware of these potential risks, and they should also be aware that if rates do start shooting up like that, it's not just bonds that have duration, equities do too. And the stocks that have higher duration are any stocks that are growth stocks where you are betting on a stock and its growth opportunity and the money it's going to make a long time in the future. So if you're looking at something like Albertsons, which is not a growth story, and you're only buying it for its current yield and its current earnings, its sensitivity to increases in long-term rates will be much less than, say, I'm going to actually exclude NVIDIA from this because I don't think NVIDIA is priced for a long-term growth trajectory anymore.
No.
I think NVIDIA is actually priced for what they're going to earn over the next couple of years because people are concerned about this pigs in a python thing.
Yeah.
And the reason I say this is because The company right now is trading less than $132 a share, and it's forecast to make 563 next year. So let's just call it 132.
Mm-hmm.
This thing is trading 23 and a half times forward.
Yeah.
It's not, they're not pricing this one for, the same growth trajectory to continue. They're basically saying it's going to hit this level and then it's going to level off. That's effectively what NVIDIA is pricing in. But there are other companies, Snowflake, I think, is an example, where the company has not made any money.
Yeah.
And it is still, look at this thing. I mean, this is just incredible. It's trading 15 times revenues and $200 on $1.56 in anticipated earnings over that exact same period of time that I was just alluding to, 130 times forward. I mean, this is the kind of name that I would be quite scared about.
Yes. Software companies are really hard to buy in their growth phase because they typically have little or no earnings, trade at monster multiples to revenue. And it's because it required very little CapEx to expand sales. If you're signing up another customer to your enterprise software, you're not building an aircraft. You're not building a car. It's you're just adding them to your list. Or if you're selling software, well, somebody downloads some, an application, and you're done. So that's why they trade at super high multiples. And you've got to be somebody that's really tuned in to the marketplace. And what the size of a market could become, because once you have your product, it's just a matter of getting it out there and selling it.
So yeah. So we have on the issue of rates, incidentally, one of the comments we just got: TLT is toast. It really feels like the 30-year could touch 8 to 9% by year end. Combination of the Bitcoiners and the basis trade. Leverage control. I will say I would discount the idea that it gets north of 8% by year end pretty substantially. I'm saying that not so much because I don't think we could return to a rate level like that at some point. Anything is possible. But it's important to understand that the rates are still under the control of policymakers. Bond vigilantes can do a lot, but the Fed can do a lot too. They can prop up the long end of the curve if they want to. And when I say prop up, I don't mean rates. I'm talking about prop up the bond market. They could just start buying longer term assets, and they could start using that on their balance sheet. So they can, in the same way that I was suggesting that, a really neat trick for the central bank and for the Treasury to have done, if we could go back in time and undo what Yellen had done, would be to issue long term, then print short term, and retire long term by repurchase. That would have been a very creative kind of thing to do. Again, I'm not familiar with all of the laws on such a thing, so I don't know whether there's something that prevents that kind of machination. But and I can also say that that's not typically the habit of the central bank and the Treasury to do things that encourage private investors to take, like banks, to put all of this Treasury debt on their balance sheets, devalue the debt, and then take it off their hands.
But we got to, I think if you're going to see 8+% long bond rates, we need substantially higher inflation rates. You got to get investors in the wholesale saying, that the system's out of control. I got to get out of this long-term paper. Because one of the things we do know, if 30-year bonds got up into that neighborhood, the economy would go into a tailspin. A bunch of banks would go under because they own a lot of long-term paper.
Bank of America would be in real trouble.
And so the system would go into a tailspin. We might get some deflation at that point. So I don't get there. That's why I kind of think that my number has been 6 and 6.5, and that'll put enough stress on the system that inflation will remain down and to low levels, not 5, 6,
Yeah.
not 2, but that
Yeah.
3% kind of range, and we can all live. Yeah, well, I guess policymakers can live with that.
Yeah, Jamie Dimon, incidentally, I think he said, was it yesterday or the day before? Let me see if I can find what where he said this. Was he the one? He had specifically said that he believed that we still face potential stagflation risk.
Yeah.
So, limited or even negative economic growth combined with a recurrence of inflation.
It's possible.
Well, Mark, I know you've been struggling mightily with your hiccups, and I
Killing
want
me.
you to recover from that. We've chewed up an hour here, and I want to give you credit for working your way through it.
Killing me.
That has happened to me. I'm trying to remember the last time it did. I hope that doesn't happen to me when I'm on Fast Money today, which I will be, by the way, for anybody who's watching wants to watch that. I'm going to be on from 5 to 6 this afternoon. And I'll also be on Market Navigator next Tuesday around 2:30 Eastern on CNBC. So you can tune in for that. But I'm going to Las Vegas to see Darkside. Because the Bitcoin conference is going on in Las Vegas next week, 27th, 8th, and 9th. And I have some people to meet with on that subject. And we were going to talk a little bit about it today, but I thought, maybe we'll wait a week and see what the folks down there are saying and incorporate that. So for all of you guys who tuned in, like, subscribe, notification bell, all that good stuff. And for those who are watching this over the weekend, I hope you're enjoying your weekend, your Memorial Day weekend. Happy Memorial Day, everybody. And remember those for whom we are taking the day off.
Yeah.
And the summer begins. We'll see you all next week.
Okay.
Thanks for watching.
See you, Mike.